As well? Good. Let Mr. Robot do the disclaimer and we'll be ready to go.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed, tracked, and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of the respective offices. Personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, and registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involve risk. Visit the OCC website www.optionsclearing.com to read characteristics and risks of standardized options. PSW provides education and training services designed to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right, way to go. Okay, so as we know, I don't know if you guys have been paying attention, but oh my God, we actually are red today. When has that last happened? The market is down. Also, it's kind of significant, actually. If we look at the charts, see if we can get these other charts up. Okay, so these are your pivot points, and what you've got, this is your median. Then you have resistance point 1, resistance point 2, support point 1, support point 2. These are what they call standard deviations from the norm. It's not normal to just plow through 2 standard deviations to the downside. Now, we just did it to the upside yesterday, so, you know, there's nothing like, there is no normal in this market. But in any case, it's all just such thin bullshit trading that it's hard to take anything seriously here. All right, I'm kind of watching the Russell right now to see right now the Russell testing 1360, and we have the Dow testing 19.8. If those two guys fail, and 2250 just fell right through on the S&P, if these guys fail, this can start getting to be a serious problem. So we'll see what happens. The dollar, where's the dollar? Oh, here's the dollar. The dollar shot all the way up to 103.6. It's now went back to 103.4, but that's still pretty strong for the dollar, except about a half a point for the day. Oil is still hanging out at 54, but I think it's done here. Gasoline also very tempting short, but you know, it's too crazy. You can't, like, you know, just because you think it's wrong doesn't mean you should be shorting it. Natural gas flying. I mean 382. Wow. Here's the Nikkei. We shorted the Nikkei earliest. That's doing nicely. It's down from 19.5. But you know that was my call. When things started falling, who wasn't falling? The Nikkei wasn't falling quite so fast. So I was like, oh, look, it's a 19.5. Now, the reason you want to do a short at 19.5 is because it's a great place to stop out. Look how pretty that is too. Okay, so here's your 19.5 line. And so back in chat this morning, I was saying that, you know, let's do the Nikkei 19.5 with a tight stop over. As you can see, it never went back over that line. Once it failed it tested it here, but it never went back over the line. And that's key. So that's when you get, when you catch one like that, that's the way you want to play, because these lines are very strong, and once they break, if you're going to get a good run down, they usually stay broken. That's actually one of the great signs that you're going to get a nice run down is when you fall through major support and can't get back over it. So, 19.5 is an excellent line. But what makes it, you have to always remember that what makes it an excellent line is because you stop out over it. That's why it's a good entry point. It's like starting out where you have a wall at your back and you can't lose. But the only reason you can't lose is if you don't break through the wall. The point is to have a place that's very likely to support you. And if it doesn't, it doesn't. Then you say, okay, it failed, end of story, goodbye. Because that's just the only reason you can count on that is big psychological support at 19.5. That goes for any of these kind of lines, and 19.8, of course, any of the 100 lines on the Dow. And also, that's what the big, when we have the big chart, I don't know if she'll only put one up today. No, he didn't. Okay, maybe yesterday. I know I remember one. Nope. Okay. Anyway, but the 5% lines that we put up on the big chart, those lines are those give you an idea of what the parameters are for, like, in other words, if the 5% lines are say 100 points apart, right? Then you know that the 2.5% line is 50 points apart. So you know that 50 and 25 in 1.25% line. So every 25, once you know that, then you know that index is going to move in like 25 increments, right? Because if the 5% number is 100, then the 2.5% line is 50, and the 1.25% line is 25. That means that every 25 line on that index is going to be a significant significant support line. So that's the kind of stuff you want to look for. All right, let's see if we got any questions. Pictures of R2-D2 here, perhaps. What? Oh, that guy. Yes, so, blah, 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 C3. Okay, great. Very important questions. Come on, guys. Anyway, as you can tell, my voice still isn't perfect from my flu last time. But I am basically better. Just not sure how long I'll have a long conversation on things. So, given the market's recent history, it would be, it's very tempting to play for a bounce here, but there's no real logic to doing it. There's not even a reason that we're selling off right now. There's nothing going on. Take a look at the Wall Street Journal. And the markets and the market data. But look at this. Look what's going on right now. 2,200 stocks declining, 80 unchanged, 800 advancing, 700 advancing. So you're talking about, what is that? 3-to-1 basically. So 3-to-1 here, close enough to 3-to-1 there. So you've got 3-to-1 declines to advance, and your declining volume is swamping. That's also 3-to-1, and it's more than 3-to-1. It's like 5-to-1 over there. So, so basically all the money's going out, but the volume is so low that it doesn't matter. It's just sort of like probably if one fund or two funds activate, they're closing out positions, and they're just trying to see how much they can get rid of into this market, which turns out not much because look how drastically it's affecting me just to sell a small amount of stock. And I've been warning about this for how long, right? I keep saying if you try to sell in a thin market, if you wait until the market turns, all right, I will come and personally smack you guys if you have not been lighting up at this point. We took a ton of stuff off the table on our portfolio. In fact, let's see, our 5% portfolio. Oh, here it is. Oh, it still looks like a lot, but we trimmed down a bunch of positions on the 5% portfolio. I'll tell you what it used to be. So in November, obviously it's a long-term portfolio. Okay, here we go. Oh, Yeah, I messed up the thing. Oh, there's the numbers I'm talking about. Okay. So as a real life example, on NASDAQ, the 5% line on the NASDAQ is 4,200, right? So that's a 200-point move. That means the 100 mark is significant, and the 50 line. So any 50 line on the NASDAQ is going to be significant. Okay, that's all you do. You just look at the spreads that you have, and you divide those. So on the Russell, interestingly on the Russell, you have a 60 point is a 5% line. So that means that 30 and 15 lines are going to be supportive. So that's a little trickier because it's harder to calculate. But you have to figure out, if you know 1320 is one of your lines, then you know that 1350 is a line, and then you can do your calculations from there. And all right, so here it is. So I'm just doing this right off the top of my head, right? So 1350 is going to be a line because it's 12.5%. That means then I can break it down further, and I break it down next 15. So 1365 should be significant on the Russell. So now let's go to the Russell and see if 1365 is acting significant. Oh, wait a minute. That's days. That's some good hours. So there you go. Look, 1365. Okay? That's what the 5% rule is. Okay, I want to keep in mind that these are numbers. Oh, wherever that thing, oh, there I lost the page. I need much bigger monitors. Get that over here. Okay. So keep in mind these are lines that we locked in from a valuation that was done in November of I think 2014, 15, 16. Yeah, we've been using these lines for 2 years, and they still work. And you know why they still work, though? Because these are the lines that end up more or less being used by the computers. The robots that trade 90% of the market, this is their logic, okay? This is how they trade. This is how they see the market. They don't give a shit about Donald Trump. They don't care about terrorism. They don't care about anything. They care about where the support and resistance lines are, and they will trade into these zones, and then once they lock into a zone, now, we don't know what zone, we don't know where they're going to be, but generally what we're saying, the must-hold line is what I decide is a fair valuation for the thing. We've been talking about raising our must-hold lines, and this is going to be our big test, in fact. The first 100 days of the Trump administration is our big test to see if we're going to permanently raise these lines by about 10%. But at the moment, we still keep them down here, because I still think we can have a nice big correction, at least to here. It's 18.5. I still think we can hit that. And if we're hitting that, why would I move my line? If we're hitting 18.5. So we will see. But, so we calculate these. This is the zone we expected to be in basically at this time, the end of 2016. Obviously, the NASDAQ's flown higher. But the Russell is right where, that makes no sense. What is this? What is it? Oh, something's wrong. How could that be 1,200? Am I crazy? Oh, that's from November 4th. That's why. 13. I'm thinking that was more recent. I'm sorry. So, like I said, we're at 13. Like I said, well, actually, we blew up from here. So, think of that on November 4th. This is only a month ago, basically. Not even 2 months ago. So 2 months ago, we were at here. We were under this line. And now we are way the frick. We went through this zone like crazy. Now, just because that happened doesn't mean you change your zones. You can't change it just because in 60 days out of 2 years of using something, you had a variation. That's crazy. Wow, I didn't even realize how much that changed. So we went from being we went from being almost coming down under here to blowing through these numbers. That's really incredible. I think we went, wow, what a huge move on that index. Anyhow, all right, So like I said, look, you can take, all you have to do is refer to the big chart and calculate. So here you have 880. That means 440, and then 210. So basically on the Dow, I'd say like every 200 points is going to be a significant line. 17.8, 18,000, and 18.2. So that means we expect 18,000 to be significant on the Dow. So let's go see what 18,000 looks like. I don't think we need to tell you that. So here's the Dow, and how's 18,000 look? Oh, not 18. Am I doing something wrong? Hang on a second. Oh, that's over here. Wow, we went up so crazy, it's hard to even keep track. We flew through 18,000. Let me curl that. So, sorry. So 200 points, so 19,360, and then 19,560 would be your next major point that you want to look at. Oh, I see. Okay. So 19,560, which is here, and then 19,750 would be your next point. And now you see how that works out, 19,750. Okay, this is how computers trade. That's what the 5% rule is for. It's to identify where the software is going to find the next support resistance. And what it means is it's basically going to be, there's programs that are buying and programs that are selling. The programs are all designed a certain way, and they have commonalities. So the 5% rule just makes use of those commonalities. It's like a Fibonacci retracement, but it's a Fibonacci retracement for computers. That's all. Because computers aren't natural. Computers but they imitate nature. They do the same kind of thing as nature does. And because you have so many transactions occurring, the same kind of natural flow and retracements happen in the systems. And that's what the 5% rule takes advantage of. Tax selling. I'm pretty sure tax selling is going to happen in January pretty heavily. I think one of the reasons the market has been so thinly traded is because there have been no sellers. And the reason there's no sellers is because there's probably going to be a drastic decrease in capital gains next year. So why would I take my profits this year and pay higher taxes when I can just wait a month and do it? And because everybody's so gung-ho bullish, nobody's seeing a reason to be fearful. You have to have enough reason to be fearful that you're willing to sacrifice at least 5%. Okay, let's say in the very least, you've got to imagine Trump will save you 5% on capital gains. So I have to believe that it's more likely the market drops 5% before I get a chance to sell in January. Otherwise, I would stick with the trade. That's going to be the logic of the people holding. And I think a lot of people are doing that, and a lot of people are holding out and keeping in the market because they want to take advantage. I mean, and especially if it's not capital gains. I mean, if it's not a long-term gain, if it's a short-term gain, you definitely want to hold it. Because if you're a wealthy person and you're coming in the next year, your taxes are going to be significantly lower next year. So that's a no-brainer. I mean, there's almost not a chance that the market's going to correct enough for you to take a short-term gain this year and pay tax on it. That makes almost no sense at all. So that's what I think. I think there's a lot of pent-up selling that's going to get unleashed in January. But we'll see. Maybe I'm wrong. Believe me, I've been wrong about it. I've been wrong about the market correcting for a long time. But this is the reason I think I've been wrong. Well, this happened. The Trump election happened, and people reacted, in a way, and also the bonds, the Treasury, the TLT. I mean, oh my God, bonds. This, not ours. Oh, meanwhile, what the hell? Wow, those are all shooting up. So meanwhile, bonds collapsed. right? 130 to 123. That's nothing to laugh about. That's like 5%. And a bigger chart. Yeah, basically you're down about 5-7% in this amount of time, in 6 months, 3 months, no, 4 months, 5 months, whatever. But that's painful. People don't buy bonds thinking they're going to go down. These guys, the 30s, are down 15%. That's crazy. And that's a loss, okay? If you try to redeem that bond, if you're a bondholder, you have a portfolio of your bonds, and it shows the value of your bonds and your cash value of your bonds. So they see this. Okay, it's not a theoretical to them. They're looking at the cash value of their portfolio, and it's gone way, way down because those bonds are killing people. People do not buy bonds to not be safe. Okay, nobody's putting money into 30-year notes. Well, anybody who did it, first of all, people who put money into 30-year notes at 3% are idiots anyway. That was the stupidest thing ever. And the 10 years at 2%, whatever. I mean, it's just, these are, the chance of inflation never coming back for 30 years is just so ridiculous. You're betting on something that's incredibly unlikely to occur, that's never actually occurred in history. But what can you do? I mean, people have been buying bonds for years on this premise that interest rates would never go up again. And they are now getting really, really badly burned. And that's where the money's coming from. People are stopping out of bonds and moving their money, and there's nowhere to move their money to except equities. Can't buy houses. First of all, there's another reason you can't buy houses, because the interest rates on houses are climbing. We just had 2 news reports today that were new home sales and pending home sales were both a very big disappointment last month. And why? Because rates are kicking up. Because people don't buy a home, they buy a mortgage. Okay, when you go to buy a house, you have a price range that you say, we can buy $800,000 to $1 million, whatever. But it's really based on you didn't decide that based on the fact you have $800,000 to $1 million in your pocket, right? You decide that because you met with a mortgage broker or something, and they said, well, okay, so you've got $150,000 to deposit, and you can cover this kind of mortgage, so therefore you can afford this kind of home. They tell you that, right? So that's been happening, and what happens is all of a sudden now you thought you could buy $1 million home, but now rates ticked up 1%, and it just knocked maybe about $125,000 off your price. Now you have to go down scale, and people don't like going down scale when they thought they can get a bigger home. Not only that though, but the taxes on houses are shocking these days. They're really killing the market. And this has been going on for a long time, but now that rates, the thing is, when rates were going down, again, you don't buy the house or the taxes, you buy the mortgage, and the mortgage will be rolled in with taxes, and then you decide what you can afford. And this is where everyone's getting screwed, especially where I live in Jersey, where the property taxes, thank you, Christie, are completely out of control, because the way Christie saves the state money is by putting more and more pressure, taking away aid that he gives to all the towns, which forces them to cover it in their own budget. Their own budgets must be balanced every year, and they have to raise property taxes all the time. All the time. Insanely crazy raises. My taxes on my house now are more than my mortgage was when we bought it. So, and we only bought it in '98. So that's a long time ago. It's 20 years ago. So, almost 20 years ago we bought it. But still, imagine, a poor retiring couple, and they bought this house, and they imagine they would be able to retire in this place. But now, 30 years later, their mortgage is more. The taxes are more than their mortgage ever was. How do they retire when they're still paying? It never ends. You used to have that dream. Your grandparents had this dream. They would one day pay off their mortgage and be done. And then they could just live off their savings. That was the way it used to work. Property taxes are some negligible thing. And why? Because the government used to take it. That big, ugly government everybody hates used to take care of everything. And they funded the schools, and they funded the roads, and they did this and that. And there was very little for the local governments to do. But now, all these savings of taxes on the federal level, the way Donald Trump gets to pay zero taxes is because your property taxes are going through the roof. The federal government doesn't give money to the local governments anymore. Not in any kind of proportion. And so all that burden is shoved down to the landowners. And yes, Donald Trump's a landowner too, but proportionally, it doesn't work out. Believe me. In fact, Malcolm Forbes, I used to do work with his people. Malcolm Forbes has a place in Bedminster in New Jersey, and he threw some sheep on the lawn so he could call it a farm. And he saves himself $50,000 a year in property taxes. He's got 100 acres, and he throws sheep on the 100 acres, and he doesn't pay tax on it anymore. It's insane. But that's the way the tax laws are. It's crazy. There's these little ways that people who have, the bigger your land is, the more ways you can find to get out of paying taxes on it. You have a regular house, regular person in the regular house, no, you're going to pay your damn taxes. Okay, but a guy with a big house, he can do an easement with the government. He can allow some electrical lines to go through, and that gives him a tax break. He can put a farm on it. He can have it declared something else. He can donate a part of the land to the road and get a 10-year exemption. All kinds of things. The bigger your land is, the more ways you can find to screw around with taxes. So, anyhow, how do we go on? Property taxes, right. So, part of the problem buying homes is the property taxes, because your mortgage plus your property taxes is what you can afford for your house, plus utilities and everything else, which are also, in some cases getting out of control. But forgetting those costs, you pay those in an apartment anyway. But it's the taxes and the mortgage. And so the taxes have been going crazy for years, and more so in the last few years, and they slipped in kind of under the radar because the mortgages were because the interest on the mortgages was so low, it offset it as a total package. So your home maintained its value, net value, even though the property taxes went up, but the amount of money you have to pay in the mortgage interest went down. So it seemed okay. But all of a sudden, you look at these things, and because I looked at some things where I'm I could save I could save $500 or $1,000 on my mortgage possibly, but by doing that, it doesn't take care of my big problem. It's my frickin' tax bill. It's not the mortgage I need to save money on. It's taxes. There's nothing's going to help you there. So now, with interest rates going up, now you have a double whammy, because you still have the huge high taxes, and now the interest rates are up and your mortgage is high, and that is going to possibly cause a really rapid reprice in housing. If we start going up past 3% on the 10-year next year, we're 2.5 now. If we go past 3% next year, we're going to get into a zone where housing prices need to correct at least 10% to be affordable. And I don't mean New York City affordable, that's another planet, or things like that. Everyone's got their own little areas. But I'm talking about normal home prices for normal people with normal incomes, not affordable. So there's going to be, you can have very, very strong repercussions at a certain point, and little things like what we had today with these housing numbers, they're terrible. And how could they go sour so fast? They go sour so fast because the Fed raised rates a quarter point. Want to see what happens when they go up another half a point? It was very ugly. So where are we? Joe. Yes, Joe. Sucks. Unfortunately, not a good time for coffee at the moment. The crops came in better than everybody thought, so right now everybody's bearish on coffee. They think there's going to be plenty of it. And we're Going to have to, unfortunately, Joe, they don't have long options. Where's Joe? And Joe, it only goes out to June, so you have to wait until June to be able to roll out and take the January options. So every 6 months, if you want to stick with this trade, you basically have to every 3 months, basically every quarter you're going to roll it out to another 3-month quarter. And each time you just have to bite the bullet, pay a little bit of money, maintain your position, and move forward. And it's possible, of course, it rallies at some point, but holy crap, it's down another 167 today. Now, we didn't think it was going to do anything until July anyway. But, until the summer anyway. It doesn't have to be exactly July. But we didn't think it was going to do anything until July anyway. But this is, we're back to the lows that got us interested in coffee in the first place. Because when we started with coffee, it was June of this year, in fact. Where are we? Soft. So we got into coffee around here. We liked it down here, and I was like, oh, that line's holding. Let's grab it. So we grabbed it. We had a fantastic run, much more than we thought. We did cash out. The problem is we started getting back in here. We thought 150 would hold, and it hasn't. So we got a little greedy and tried to come back into 150. I thought that line would hold up and consolidated well here, but it just went flying down. Now, it went flying down, though, with the market rallying and the dollar rallying, and of course the bad crop report. So it got triple whammied. And I still think that somewhere between, like around 150, at least 140, 150 is the right number still. So I'm sticking with it. I'm pretty confident that this is going to be the right line over time. But over time, we don't know when time is. That's the problem. Yeah, Jim's right. Isn't Joe a 5 to 10 year play? Yeah, it is. It's a long-term play. So, it's like watching it, when you're playing crops, you don't watch a crop and go, oh, wait, what happened this week? It's like, no, it's a freaking crop. It's seasonal. Okay, so there's a growing season, and that's it. So once a year, there's a growing season, a harvesting, there's a growing season, there's a harvesting time, it's planting, growing, harvesting, wait for winter to end, start again. That's how crops work. So if you don't have like a 5-year time frame, you can't really even play it. If you're going to sit there and watch it like it's freaking day trade, forget it. So what happens in between that time is meaningless. Okay, this is the timing for watching coffee. So we think that we think at least we're going to go back this way. A little bit back up this way, but still, look how long this took. 2015, 2014, 13. So we're talking 3 years, 4 years, 5 years. All right, so let's give it more than a month. But obviously, very disappointing to start with, but also a great opportunity to have a great position. I think we did just adjust it, didn't we? Did we adjust our coffee trade or not? I don't remember. Let's see. Joe. Oh, no, I know what we did. We decided to wait because we didn't, okay. We decided to wait because we didn't want to put more money in while it's falling. But, this is not a big position. We spent $2,100 here on this spread, and we have these puts, but the puts aren't really that far out of the money, okay? So they're not a big deal. The puts only fit, a 60-cent loss. And we only sold 5. So this was a very small entry position in the options opportunity portfolio. So what we're going to do in this one is we'll be doubling down. We're going to go to 30 probably. But not now in June, I'm not sure. We're going to certainly go to June though on these. I'd like to hold it out for September. I mean, these are Marches. I don't know when the next contracts will come out, but at least we're going to wait till January clears up and see what happens. But once we're in January, if they haven't got longer than June to roll to, we're going to then do that. Now, what are we going to do? We paid net 210 for the spread, and right now we're at a 50% loss on that spread. So you're talking about but you lost $1. It's $1,500 is what we've lost so far in this trade. If this trade had paid off, it would have paid us back $3,000. All right. Well, actually, more than 3,000 because of the short here. But we're gonna, we took a stab at it. It didn't work out. We lost. And wait, 15? No, I'm sorry, $4,500, not 3,000. We made $4,500. So instead of making $4,500, we lost $1,500. We lost 1/3 of what we thought we could make. That means we can make the same trade again, and if it goes well next time, we're still going to be up $1,500. If that one doesn't work out, the next time we'd want to double down and try it again. But don't forget, the only reason it wouldn't work out is because coffee goes even lower, and that means that we're now we're betting that the all-time lows are going to hold. At a certain point, this is a 20-year chart. At a certain point, back when I bought my house, right there. So at a certain point, you got to say, I don't know. I'm not sure how cheap coffee can get. I mean, we certainly drink way more coffee than we did back here. We're growing more coffee too. But this thing is probably going to correct. I think this is just a bad set of conditions that gave you a very unusual sell-off, and it'll hopefully start stabilizing. Then we can make a better trade. All right. I wish they had longer-term options. That's the only thing about coffee. It's very annoying. Because I'd much rather play with 2019 plays. This talking strains my throat, guys. I've been talking much during Christmas. Everybody's like, "What's wrong with you?" I'm like, "I'm trying to save my voice." So what's going on? Okay, what does Kate look like? Forgot about those guys. Kate. There you go. Wow, that's funny. So the buyout rumor on Kate. And did we make an adjustment for those guys? Kate. No. All right, well, that's all right. So actually our goal was 20. And they're at 17, so we're in good shape. So that if there's a buyout, that's not enough money for us. It's less than we thought it was worth. But either way, that's going to be fun. So we have the 15-20 spread. We sold the 15 puts, and it was net zero. See, we said net zero on that 5,500 minus 33 minus 23. So anything above 15 is profit for us. So if we're at $17, that's a $2,000 profit. So if they do get bought out, even if it's at 17, it's not terrible. I'm pretty sure they can do a lot better than that, though. I'm getting confused. All right, let's see. Oh, okay, great. All right, I cannot talk to it. I'm realizing now I'm not going to make it if I keep talking too much. So I'm not going to be too long with my explanations, hopefully. SCO thoughts on that, should we hold until January 20th? No. No, that's a dead trade, basically. Again, I assume the options portfolio. Oh, there it is. Okay. Oh, I know what I want to do. I want to wait until tomorrow for the thing. Yeah, I want to see the inventory report. So but it might not be tomorrow. It might be. No, it wasn't today. It will be tomorrow. That's right. What's all doing now? What happened? Oil's still going up. Wow. Okay. Well, it's not looking good for the indexes. It's still down here. All right. So this is probably going to be bad, but we'll wait and see what the inventory report is tomorrow, because realistically, how much is it going to hurt to wait? I'd rather wait and have more information than just make a move for no reason. See, here's the philosophy behind these spreads. There's no real damage here because we paid $2. You know, 204. No, it's 196. All right, we paid $2 for that spread. Okay, we bought these for 905. We sold those for 709. The spread cost us $2. Right now, we can sell the calls for 245. Now, you say, well, if we sell the calls for 245, though, we have these naked 70 calls. Well, the only reason you're selling the 65 calls is because you don't believe that 70 is going to get hit, right? You wouldn't be selling the 65 calls if you thought it was going to bounce back to 70. So we're selling because we no longer believe that target is valid. So we can take 245 off the table and leave the other money on SCO, but I want to be sure that oil is going to stay up. So I want to see those inventory reports tomorrow, and I want to see what the reaction is. And we have that OPEC, and then we have on Monday the OPEC meeting. Not the meeting. The OPEC cuts go into effect on Sunday. And so we'll see what, sometimes when the actual thing happens, people sell on the news. It's called buy on the rumor, sell on the news. So sometimes when the actual event happens, you get out of the trade. So it could start unwinding on Monday. But if it does, you could always cover it. So I'm inclined to take those off the table. Okay, although I want to wait till inventories, but I'm inclined to take those 65s off the table and just leave the 70s. Because it's going to be very hard for SCO. Where's my thingies? Where's my charts? These. Whoa. I'm scrolling mouse. All right. Aha! Why did it do that? Open new tab. Great. All right. So SCO. It does not seem likely now that we're going to fly back to 70, but we do have 30 days. So it's not, but on the other hand, you can get really burned on this thing. See how it goes? Here it comes to 70 to 90 in like 2 weeks, or not even 2 weeks. In fact, it's 1, 2, 3, 4, 5. There you go. So you don't want to be on the wrong side of this thing if it does take off. So we'd have to keep tight stops on the 70s and take a chance. But hopefully we can recover our money. Now, if we want to, the problem is, the reason that is because I don't want to stay bearish on oil. Okay, this was the time of year that we thought it was going to go lower. If it's staying up now, then it might skip right into the spring and stay high. And we'll at least flatline in the 45-50 range for the spring. At least 45-50, possibly 60s. Or certainly 60s by July. So we have, and we do in the same portfolio, we have a bullish position on USO, but that's timed out for July. Right in the same section. We have the bullish USO play, which you'll notice is bigger. And this one is a $3 spread. It pays $6,000, and we bought it for $2,600. This one, as I said, we paid $2,000, and it pays $5,000 if all goes well. So the point is, this one was really, we thought timing-wise it would work out, but it didn't. But this one was meant to be, a hedge against the short-term correction, and then we would still be bullish on USO. But as it turns out, the USO is practically in the money already. So actually, if you net these out, see how that's a $900 loss there, and we have a $1,900 gain here. So we net $1,000 on the spread. On the the full positions. We bought these first, then we bought back to protect this. Because we thought short term we'd have a correction. Didn't have the correction. Okay. We mitigated some of our gains, but it didn't hurt, and it was better than taking this position off the table when we were worried that we might have a correction. It's all about balance. So this didn't hurt us because it balanced with that one. You know, you always have to think in terms of what you have in your portfolio already, and are you balancing? Are you doing a better job balancing, or you're unbalancing your portfolio? So, well, we're doing good here, 135, which is what? Which is $235,000. That is very, very good. You know, we only started this thing in August of 2015. Is that right? Yeah, August 2015. So it's just a little bit over a year old. So that's doing very well. And we try to keep it balanced. We don't want to have big giant swings in the portfolio. You know, we just want to try to scratch that $1,000 that we scratch out. That's what we want to do over and over again. Scratch out a $1,000 win without taking a huge risk in either direction. Discuss strategy to lock in profits when a bull call spread jumps up way ahead. There's no real strategy to that. I mean, my favorite way is I will tend to, I look for when I think it's getting toppy, I seek to, well, okay, you know what, I hate to see, this is my problem with strategy, there's so many if-thens. Assuming I still like the stock, like let's say it was Apple, okay? And let's say I have the Apple 100-130 spreads, which we do. So we have the Apple 100-130 bull call spreads. And they're 2019, I think. So let's say they were 2018, though, because otherwise it doesn't make any sense. So if we have the 2018, if you have 2019, nothing. You can't do anything about it. You're just stuck because there's nowhere to roll to, and there's no fancy ways to fix it, other than possibly selling a few short calls to just, you know, to basically offset a possible drop. But if you have the Apple 2018 100-130 bull call spread, well, actually, we'll take a look at what it is. Okay. Apple 2018. Okay. So the 100s. Okay. You said when it goes away in money. So I can't do an example. I was doing a theoretical example, but now we're going to look at numbers. You need to do a real example. So let's say we had the 80-110 spread. No, let's say it was a 70. I'm trying to say if it went way in the money. So let's say we had the 70-100 spread, and let's say we bought it for $15. It's a $30 spread, so that's about right. It's what we would have paid for it. And now it's 25. I would say about $25, okay, because the 70s are about 47 and the 100s are about 22. So yeah, let's call that 25. So now it's 25, and you want to make sure you get your money. And for whatever reason, you want to take it off the table. So, in my mind, I like Apple, but I still think 130 is a fair price, even after the good news. So I'll say, you know what? Or no more than 130 anyway. So I'll say, you know what? Here's what I can do. Instead of cashing in the spread, now you have to be able to afford this though with the margin and all that. But I'll cash this. So I think this run is a little bit overdone to 116. So I'd say don't get confused though. I'm just saying for example. So if I thought the run was a bit overdone at this point, I would cash these for $47. I would then decide what reasonable spots I wanted. So I would take my 47 off the table. I will go down here. Now, my obligation, of course, is I have the short 100 calls. So I would buy the 90s for $32, and I would sell, I'm going a year longer, and I would sell, well, let's say $32, and I would sell the 120s for $15, so that's about $17. So I took 47 off the table, and now I'm going to buy a $30 spread to cover the short calls for $17. That means I took 30 off the table, which is the most you could have made on the original spread. I've now taken off the table. And now I have another $30 spread. So I could end up making $60 if this plays out perfectly, which it probably won't. But I can, so I have another $30 that I'll make if Apple stays over 120, if it's over 120 in 2019. But I do have this obligation on the 100 calls. But what's my logic is, if Apple goes over 120, I would stop out probably half, which means I would give back $10 or $12. So let's say it goes higher. Let's say I give back about $13, $14 out of my 30 in my pocket. So I'd be buying back half of these, and then I would roll these. So that means I would still have half the money in my pocket from the spread, and now I have a very manageable half-covered position where I make $30 if Apple continues to go higher. So I still make more money than I would have started with after I'm done with my rolls. Oh, and by the way, I will also sell some puts, of course. But now, and by the way, if you have naked short calls, there's absolutely no margin hit. You in fact save margin by selling short puts. The short puts offset the short calls. So whenever you have short calls that are naked, if you're trying to offset margin, you can sell short puts. But again, make sure it's logically what you want to do. For me, logically, and I think I said this yesterday to people, the 97.50 calls I can sell for $8.50. Of course, I want to own Apple for 97.50. Why wouldn't I? So I would sell those and not think twice about it. Now, especially if I already sold 100 calls, now it's a no-brainer. If I can't lose both, so now I've got instead of just having 21 here, I have 21 here. But if I lose that anything on that, I'm going to make it on this. You can't lose both. Count on Apple. That's why your margin will reduce when you sell them both instead of so that saves you margin. So that's how you do it. But again, it's not I don't want to get that confused with being like, this is what you do every time. You have to look at the situation, think about what you think is going to happen next, and decide on your long-term strategy. And also take into account your cash situation, your margin situation, everything else. That's like I said, that's what I like to do. But again, that's because we have the long-term portfolio is our main strategy. Is in the 5% we're a self-balancing portfolio. So, but here we wouldn't do that here. See, we very rarely leave naked calls because it's not a big enough portfolio to handle it right now. It's not appropriate for this portfolio. But in the short-term portfolio, do it all the time. Look at the margin requirement of this portfolio. Okay, margin requirement $856,000. That's a lot of margin. But you know what? The short-term portfolio is paired with the long-term portfolio. Which is only using $623,000 in margin on $1.2 million in cash. So we got $2 million in buying power here. We're only using $600,000. We got $1.4 million in spare margin. So you have to think of the long-term portfolio and the short-term portfolio as two portfolios in your broker account. So the margin is jointly shared. We keep so much cash in our positions that we're swimming in margin. So we do those high margin plays all the time in the long and short-term portfolio because they're very rewarding, but you have to be able to handle the risk of it. And again, it's all about balance. You always have to be aware, if the market does this, if the market pops, then I'm going to get buried on my short Apple calls. And if I get buried on my short Apple calls, how much money will I make on everything else? And again, I wish my voice was better, but let's pretend I'm counting this. $50,000. I'm going to make $50,000 in short puts. I know that for a fact. I have this many short puts. I can see the numbers. Actually, it's more like $100,000. So, well, we got rid of a lot of them. So now I got to look. 5, 25, 30, 40, 45, 50, 60, 70, 80,000. Okay, it's right in between. So $80,000 worth of short puts. If the market flies up, I got $80,000 locked in. That's why we always sell some short puts. Like every month, we try to find some short puts to sell. It's simple, and look how green they all are, except for poor GNC. So we always look to sell some short put money. Because if the market goes up, that in general is going to raise everything. We'll do well. Wow, somehow I got creamed, huh? A couple of losers makes you focus. I know I'm going to get that money. I know I'm going to get my dividends. We collect $50,000 a year in dividends. I know I'm going to get those. Okay? All these spreads. I know there's probably about 100-something thousand, 200,000, almost $200,000 in projected profits on these spreads. Now, if the market's flying up, I know I get that. So let's say 150, 50 is 280. So let's say $250,000. So I know I'm making $250,000 in a big bullish market. That's my layout in my long-term portfolio. I know that's going to happen. So am I going to freak out that my Apple position loses $20,000 because I took a change in it because I wanted to cover Apple? No. That's what I mean by balance, though. You have to think of your whole portfolio and how it affects it. You know, I'm not saying I want to lose $20,000. I'm saying you make an individual decision, but you think about the individual decision and then say, well, if it gets wiped out, what does that do to me overall? And the only reason Apple would get wiped out is because it flies higher. If Apple flies higher, it's a major component in the NASDAQ, the Dow, and the S&P. That means the entire market is very likely to be heading higher. It's possible Apple does something spectacular and the rest of the market doesn't care, but not that likely. So, you know, if Apple's flying higher, probably the whole market is flying higher. They have a pretty good correlation. And so I know where I'm going to stand. And on the other hand, when I make a big bullish bet on Apple, then I buy more SQQs for hedges because I know where my losses are going to be. So you always have to think in terms of the whole portfolio. It makes everything much, you know, once you learn to do that, it makes things much more clear. It's like it's like in chess when you just sort of like, if you learn chess, you learn like a basic game, and then there's like layers and layers and layers and layers to learn, which is, you know, a lot of people get lost after one layer. But, you know, if you get, the better you get at it, the more you practice, the more you start seeing all the little bits. And as you start to see your whole portfolio and think of the whole thing, you know, forget chess, it's like football, right? I mean, you know, you can teach someone to be a running back, but if he doesn't understand how the entire game goes, if he doesn't understand what everybody's position is doing and how a play is going to be run and what everybody's job is in the positions, then what's the good of having a running back? What's he going to do? This is a team effort. Your portfolio should be a team. The positions are a team in your portfolio. And they should all be doing their jobs. And you got to think of them that way. And we have articles, by the way. If you go to the in our education section, probably deep back, but there's smart portfolio management articles, and there's 3 of them for small portfolio, medium portfolio, and large portfolios. And we talk about all this stuff. So I'm going to save my voice. Twitter, end of last September. What? Okay, same thing. So Twitter. SVXY, no, they got killed, didn't they? Or not got killed. Well, no, they did. It went the other way. SVXY did well. Why were we bearish on it? I lost track of that one. But again, I'm very reticent to make any kind of moves in an incredibly thin trading week like this one, because nothing that's happening there really has any meaning. So, where were they? Oh well, whichever portfolio they were. But anyway, so we haven't, you know, obviously went against us, and we have to think about what they're doing. But I don't want to jump into it, so we're just going to give it a look and see what happens, basically. So, I know what that was. Yes, no, because we thought at some point the VIX would pop. What was the month on that? Was that in the short-term portfolio? But it's the same thing. It's a hedge. There it is. Yeah. Okay. So yeah, it's a small hedge in the short-term portfolio, and frankly, look, it's down $700. No, wait. 1,300. Minus 55, yeah. Okay, sorry, it's down $1,300. It's down $1,300 in a $500,000 portfolio. It's a hedge. You know, our hedges are supposed to lose money when the market's going up because the long-term portfolio is making an incredible amount of money. I'm sorry, this one. This is March. So do we not think the VIX is going to go up between now and March? Is going to go down between now and March? You know, I still think it's got a good chance. I mean, you know, I don't want to adjust it for no reason. The net price of the spread hasn't changed that much. So we got plenty of time. And again, same concept with the spread. We paid, we paid $3 for it, basically. Okay? And we can recover $5.75. Now, here's the question. Do I want to leave the naked March 70 puts on SVXY? So I go SVXY. And I say, if I give these guys 3 months, do I feel confident that they won't go below 70? And I would say, not really. They certainly go up fast enough. They never do go down, do they? But they go up fast enough. I mean, let's go away. Here's one where it went down. So here is in 1 month, we went down 65 to 4. Wow, that's a big drop. So we went down 25 out of 65. So don't forget those. By the way, there's also a big mistake people make in charts. They look at these things and they say, a $25 drop. No, it's a percentage that matters, not the drop. So when we're at 90 now, it's going to be 50% more than 25. It's going to be 35, or 37 or whatever it is. So now we say, well, what's a 37-point drop? And that takes us all the way down to 60. So in 1 month, this thing's capable of moving all the way back to 60. So I don't feel real comfortable doing a roll yet because but again, we would do a roll and we would pick up a longer time frame spread that would cover the short puts. Then when the short puts expire worthless, we just have the new spread at basically no more money than we spent in the first place. But again, you don't rush them because you have 3 months. This is why we take these longer term plays. We don't need to rush. There's no pressure. We get to wait and get better information. Wow, what the hell is everybody? Is there nothing else? Is everybody off work this week? So it's going to be a quiet seminar today. All right. So the FLW puts on trade of the year, but I can't get sold on the bull call spread, so I move up my bid. Look, again, very thinly traded market. It was my trade of the year. It was published. I think we caused it. I don't think that it's up. I think it's up because we made it go up. It's up at 2. Again, back to the 5% rule. At 2.5. The 5% rule is just a name for it. It includes 2.5% and 1.25%. So I think we caused this because the timing was exactly. You can see that on the stock charts, I think. SW. Yeah, I published on December 25th. I published Secret Santa's inflation hedges, and I went up to here. Yesterday, I published it. I put out the note that it was going to be our trade of the year, and it went up like that. And silver hasn't gone up, so I think we did this. So I wouldn't chase it, and I wouldn't start overbidding it because I think we caused it. So it could easily pull all the way back. So I wouldn't go too crazy. And, again, just, you want to be careful. But I mean, if I was doing it, frankly, if I was doing it, I would sell, let's say, half of the calls naked. If they go over 1860, I would cover. And whatever costs. And I would cover and just say, okay, it didn't work out. But I would take a chance here at 1850. I would sell half the calls naked and wait for a pullback to buy the long calls to cover. That's how you leg into a spread. You find a range you're comfortable with, you watch it, and you say, okay, I think this is going to top out here. So you start selling some calls, and you're going to get a really good price for the calls you sell here. And then you know what your plan is. Now you must cover very tightly though. You don't want to let this thing get away from you. All right? But in fact, you can even sell the next bracket. You can even sell one bracket up. You know, so I forget which ones we were going to sell, but if we were going to sell the 20s, you could sell like the 2250s or the 25s or whatever, so you probably get the same price, but you get a wider spread. So depending on which one you're looking at, when you're selling, if it was a 1525 spread, then you can do the 1527.50 spread or the 1530 spread, something like that, because you can probably get some really good money for the higher calls right now. But either way, or you can just take the good price for the 25 and just make damn sure, though, if this thing goes any higher, you cover quickly with the 15s. That's all. The SLW spread is inflation, it's mostly inflation spread, but I think also infrastructure spending brings about more industrial, and then silver has industrial uses too. So I think there's a couple of ways you can win. Also, interestingly, another reason I like silver though, there's a couple of countries that are cracking down on gold because people are starting to, everyone's trying to get cash out of these countries, like, Argentina's falling apart, Brazil's falling apart, Venezuela's always falling apart, China's falling apart. There's a lot of places that have problems. And gold is, of course, that, in vogue for people like that. And Bitcoins now, too, right? Bitcoins are going crazy. So the governments are cracking down on gold. Some people have switched to silver, although silver is really not a good way to move money around. But still, it's something, people put it in ships. And a ton of silver is a lot of money. So people can transport a ton of silver back and forth places. They put them in boats, and they use it for currency. China's got a lot of rules. You've got to be careful in this country when they start cracking down on things. But you push money, you push people into something, and crazy things can start happening. How company you on the SLW play? Wait. So I didn't get the initial one in the OLP. I just put in yesterday because I didn't get the initial one in the OLP. How confident am I? I've traded a year, so I'm pretty confident. I looked at every other position I looked at every other market play, and I said, that's the one I like the best for 2017. We have Joe March. Yeah, okay, right, we did that. How about selling puts on Joe? Yeah, I like that. I absolutely like that. As per Logan, the SLW vocal spread, okay, we said that. I wait to fill the SLW. Should I wait or chase it? No, I hate chasing things. Like I said, if I was doing it myself, I would sell the short calls. I would sell 1/2 the short calls now. If it goes over 1860, I would cover very, very quickly with the long calls, and then you've got the other half to fill. I would try to get a good price on the other half. But I'm a gambler. I think that's a worthwhile gamble. I think it's going to pull back because I think the only reason it's up is because we're in a thinly traded market, and I picked it as my trade of the year, and it's been distributed, and people every minute people are coming into the market, reading what I wrote, and saying, "Ooh, let's get some silver wheat." It's my trade of the year. I had not missed. Not to brag, but I've not missed on a trade of the year ever. They consistently have been getting 300 to 500% gains. So it's a good track record. I say, yes, how much faith do I have in it? Well, I hate to break my streak. Okay, it's a really good streak. So I feel good about that one. What sector should we be overweight in 2017 for longs if you follow? I mean, again, the market's overbought. Okay, you shouldn't be overweighting anything. You should be underweighting the market and overweighting cash. There you go. That's the overweight sector. Overweight cash. I just did the secret savings inflation hedges. Overweight cash, ABX, SLW, so commodities basically. DBA is another one I like. That was my runner-up for trade of the year. And you know why? Because they haven't popped with the market. So if the rally is real, then the commodities should start catching up. If the rally is real, then there will be more movement of money, and prices will start rising. There will be inflation, and gold and silver and even food costs should start rising, and those picks should do very well. My secret Santa's inflation hedges. You know, and it's funny because I mean last year, what did we make on these things? Because this is what happens every year. It's the weirdest thing. It's like I can tell you, like here, I picked 4 trades last year. One of them didn't work, which was DBA in fact. So in 4 trades last year, though, we had what am I doing? Here you go. So we laid out on $3,500 laid out. We made $8,900, which is 254% in 12 months. And one of them didn't work. That's only getting 3 out of 4 right. You make 254%. So obviously, if I'm going to say you overweight something, I mean, this didn't work. These trades did not work this year. Look at XHB. It's flat. It didn't really work. XLE was a home run. DBA went the wrong way. UNG was our trade of the year, so that did well. But, you know, I don't know what to say. I mean, I don't understand. Is 254% not enough money? Because these trades will make more than that. So, yeah, I like all these trades. You know, in Silver Wheaton, DBA, Sunoco. Oh, I like Sunoco. I want to put Sunoco in the options opportunity portfolio. It pays 12%, I think. Was that the number? Where is it? Sunoco. Plus dividends. I didn't mention how much the dividend was. That's funny. Oh, 12% dividend. I knew it was 12%. Okay, good. So I want to have these kind of trades in the options opportunity portfolio. I want to teach you guys, and also in the LTP though we should put it, because in the long-term portfolio. So I want to teach you guys the value of some solid dividend payers in your portfolio over time. The very important lesson that everybody is too impatient to learn. Okay? This is Sunoco. You know Sunoco. They've been around forever. They're a good company. They make good money. They pay a gigantic dividend. And they have fantastic option prices because they're so frickin' volatile. And it's because mainly they're a refiner, and all the refiners are crazy. So this kind of stuff, see this kind of volatility, you know, all this jibber jabber. But and really though, if you own them right, you buy them for 30, and at the end of the year they're at 28. Okay, so this is a bad year for them. But even then, if you buy them for 30 and they're at 28, look what we're doing now. Okay, so we're buying. Oh wow, I guess it went up. I guess it's higher than it was when I wrote this on Christmas. But anyway, conceptually, we're buying this thing for $27. We're selling calls for $330 and puts for $160. So that's like $5 off. So we're going to net in for like $22. Okay, so you're going to net into this trade for $22. And you sold the 25 calls, so all they have to do is hold, and that's June, by the way. You sold in 6 months. All they have to do is hold 25, and they're at 27, and you're going to make $3 on 22. You're going to make 15% in 6 months, plus you get the dividend payments, which is another 1,600 out of 22 is another 8%. So you're gonna make over 20% in 6 months on a simple trade like this. And if you get called away, you do it again. Obviously, what we do is we roll. When we get to June, we're going to roll the calls and just run it into the next quarter, the next year, whatever we have. Big dividend-paying stocks tend not to have long-term options. That's just a rule of thumb. They don't do it. But these pay for a dividend, for a large dividend payer like Sunoco. These are fantastic option prices. You have an incredible, because you're selling the 25 calls for $330. That's $28.30. That's $1.30 over. That's a lot more than the dividend. As long as my call premium is higher than the dividend, I don't care if I get called away, because it's more than the dividend. Sometimes they call you away before you get the dividend, so they get the dividend. I don't care if I get called away, because if they cancel a premium on the call I sold, it's the same for me as collecting the dividend anyway. And all I do is go back and buy the stock. And that's another reason, by the way, that they're so volatile, because every time they pay a dividend, it's they're paying 10%. 10% of the stock price. It's not 10% of earnings. If the stock price, probably their earnings is probably 30% of their earnings is paid out in stock. It's paid out in dividends. So if you're paying 10% of your stock price dividend, of course they're going to be down $2 at the end of a year. They paid all the cash out. So unless they have a really good year, which this wasn't, then they're not going to do well. But I don't care. Because like I said, what do? We sold the calls $2 below where we were. So had we done that, and it was only till June, so had we done it here, we would have gotten called away here in June, right about here, we would have been called away because we sold the calls $2 below where we were at 28. Then we buy in again at 28, we sell at 26, so we get called away at 26, and then we go out till probably November. We would have sold something in November or whatever, and we get called away at 26, and now here we would have been lucky actually, because we wouldn't have gotten called away, frankly, because then sold more puts and calls at 25, and we'd be on track to be called away now. But every time you're selling these puts and calls, you lower your basis. The worst thing that happens to you is you get assigned more stock and you double up. You have to be aware of that risk, but you get more stock, you double up at a low price with a solid dividend payer. There's nothing wrong with that. But the problem is, it's like coffee. It's a slow, seasonal, long-term play, and you can't rush it and you can't day trade it. You just got to let it go and stop staring at it. When you check on this thing in June to see where you are. Unless something catastrophic happens, like there's an oil spill or something like that, or their plant blows up. Whoa, Dow's down 100 now. It's not a big deal. Anyway, so I really want to teach people to do more of those, because it's such a great way to make money long term. And that's the kind of stuff, though, once you work your basis down as part of your portfolio, you have a zero-cost basis and you're just collecting dividends. Fantastic. It's like your retirement right there. It's like, hey, there's my retirement plan. Well, any adjustments should be considered No, because there's nothing we can do about it. It went our way, but it went there really fast, and our trade's our trade. We just gotta wait and see what happens. And also again, I guess everybody is such a day trader. Basically, that's the problem. It's like you gotta learn to plant your trees and then leave them alone. It's going to take them a long time to mature. Staring at them every day won't make them grow faster. Okay? And if they have a good day or a bad day, if conditions are good, conditions are bad, it doesn't matter as long as you know that as long as you feel that everything is right as far as like it's not in any immediate danger. And this isn't in danger. It's just moving in the direction we thought it would move, just very rapidly. So great, okay, but it's not like you don't have to adjust everything. This is everybody over trades. Because everybody's like trained to be a day trader and get in and out of things like this. You've got to start thinking of being a more long-term investor. I mean, you know what you need to do first of all? Look at your account and drill down on your account. This year, your account statement's being broken. How many fees are you paying? How much money is it costing you to keep trading? And that's what you got to look at. Because if you find out that you're paying some significant amount of money in trading fees and broker fees and commission fees and so on and so forth, you got to think about the fact that you don't need to do that. You can set up a trade, you can walk away, and you can come back in a month and take a look, and then you can go away again and come back a month later. That's what we do in the long-term portfolio. That's what we do in the butterfly portfolio. 1 day per month, we look at those portfolios. We might add a trade during the month. We might say, oh, there's a good trade for the long-term portfolio. But you know what we do? We take the trade, we make the trade, we put it in the long-term portfolio, and we don't think about it again for a month. Other than J-Bob saying F you to whatever. But generally, we don't think about the trade. If the trade's going bad, one of our guys, J-Bob, he's like cursing him out. That's how we know when they're going good or bad. So if he's not talking about it, it's probably a good trade. But on the whole, if you leave them alone and you made a good choice, they're going to eventually pay off. But you got to learn to leave them alone. I rarely meet anybody whose constant adjustments to their trades makes them more money than if they just leave them alone. And I'm not saying don't fix a trade when there's something wrong. I'm not saying somebody has a bad report or some fundamental disaster happens to a company, you don't need to do something about it. But I'm saying in general, just because something goes up one day or down one day or whatever, you can't start making adjustments based on that stuff. You're just going to overtrade yourself to death. Yep, there you go. Here's the list from J-Bob. You have Gilead, Coffee, Ford, really? Restoration Hardware, Frontier. Oh, these are all great stocks. Twitter, GNC, PSO. Wow. That is if you want to list, hey, who asked about that? Who asked about what sector? These are great stocks that are cheap. All those stocks they're all in long-term portfolio that aren't doing well at the moment, but they're all great stocks. Where are we? What is going on here? Should we still? I wish I keep better track of this thing. It keeps moving on me. Kate, we talked about. Okay, what do I think of REITs? It's not what I think of REITs. I think the well-managed REITs, like we love Annaly and Chimera and ARR. The well-managed REITs do fine, and they know how to deal with rising rates. Now, by the way, you don't want REITs managed by young guys, because young guys don't even know what rising rates are. Okay, it's been a long time since we've had rising rates. You need veterans who've gone through like 30 years of real estate cycles, and they're like, okay, I know exactly how to play this. So you want the well-managed, old-school REITs with solid people back there who know how to do this stuff. But they're fine. But by the way, but my opinion of the REITs doesn't mean anything, because what matters is the sentiment of the REITs, and the sentiment of the REITs when the rates are rising is horrible. So I think if you're going to play the REITs, play them lightly and look for opportunities to add on the way down, because there's very likely going to be a way down. How do you feel about junk? I cannot understand what is keeping junk up. I really cannot get this. These are junk bonds. I do not understand why they're not dropping much faster. We shorted them. We have them in one of our portfolios. I don't understand how this is even possible. Rates, regular bond rates are going up. These things should be in big trouble, and because people have been buying junk bonds for like 6%, which is ridiculous. And these companies are levered up the ass in debt, and they are going to get crushed when rates rise. And I think this is a huge unwind waiting to happen. But it just doesn't stop. This made sense to me, and then it stopped making sense over here. This made perfect sense. It's exactly what I thought would happen, and then it immediately recovered and went even higher. So to me, this makes no sense. This is what I thought would happen. And my shame, because it went down here and we didn't take our profit. It went below 35, then back over 35. We should have stopped at 35 and gotten out. We didn't. We blew our gains, and now we're back. We lost all this money because the time frame blew. I just don't understand this. So yeah, I love it as a short up here. I think it should be down at least back to the 35 line. With the rates rising, it's just sort of it's ignoring it. It's like it's saying it never happened. NRF is another good one. I see that one. Let's see. Do you still see Trump tweets eventually working against abolitionists anymore? Yes. He's a psychopath. He tweets whatever's on his mind as if I don't think he understands he's the president of the United States. Or I don't know what he thinks. It's weird. Look. He's like a bad king. Okay? Like you watch Game of Thrones, right? And most people watch Game of Thrones. Anyway, but the bottom line is there's a kid who's raised to be the king. And he's just basically a spoiled brat who always gets his way, and then his father dies and he's king. And he's a terrible king. He's got no skills to be king. He always felt he deserved it. And when he doesn't get his way, he freaks out and starts cutting people's heads off and so on and so forth. Okay? That's Trump. The kid's got the kid sits there. The idea of the kingdom set up where you have a council and you have advisors who know how things work. The team that ran your father's kingdom really well for 20 years is sitting there and telling people what to do, and the idea is that you use these wise people as your advisors, and you do it. Now, Trump didn't do that. Trump said, fuck everybody who knows anything about Washington. Let's get all advisors who don't know anything about Washington. All right? The only guy I like actually is Tillerson. Tillerson, I conceptually hate him. The CEO of Exxon should not be the Secretary of the United States. That's the worst possible message you could send out to foreign governments. But at least he has the skills, because his job was to negotiate with foreign governments. Exxon has their own goddamn intelligence agency. So he knows how to run intelligence ops. He knows how to do covert ops. He knows how to rescue people from pirate ships. That dude is a really qualified guy to be Secretary of State. I like that choice. But I think he's there because he's an oil man. I don't think he's there because he actually has skills. I don't think Trump gives a damn about that. He's there because he's the big oil guy that they want to put in. But Trump, though, is like the kid Joffrey, the king of Game of Thrones, who they finally killed. He just, whatever he feels like, he does because he thinks that he deserves it. And basically, if he says it, it's the law. That's what the kid says. If I'm the king, aren't I? And they're like, well, yes. He's like, well, then if I say it, that is the law. Because they say, oh, that's not legal. And he's like, it's illegal now because I said it is. That's Trump. And it's not just that. He feels that way about whatever he does in America, and he feels that America is the greatest country in the world, and therefore whatever America does, whatever he says, goes for anybody. And if he tells China to shut the hell up, China better shut the hell up. And if he tells this guy to screw off, they'll tell him to screw off. He doesn't care what other people think. He doesn't care about the repercussions of his actions. Eventually, that can go bad. So yeah, I consider him an event that could go badly any time. It's not a good thing. It's certainly nothing to be record high in the market about. What's his fight with Yellen when he wants $1 trillion bond to make? Oh, that's ridiculous. He wants an illegal bond so he can spend money and pretend it's not a deficit and pretend it's not part of the budget deficit. He wants a freaking $1 trillion to hand out to his cohorts as infrastructure money, which is what Christie did in New Jersey. Christie destroyed New Jersey doing essentially the same thing, except he did it with $3 billion. Christie, I don't want to start on this. Christie, when he came into office, New York and New Jersey, for 20 years, had been building up a fund to build another tunnel. Because the Lincoln Tunnel, we have three major connections to New York. We have the Holland Tunnel, the Lincoln Tunnel, and the George Washington Bridge. Millions of cars every day go across these things. If anything happened to any one of them, it would be completely catastrophic. I don't know if it can be even described how horrible it would be. I mean, like in 9/11, they closed the Lincoln Tunnel for a while. You couldn't move within 20 miles of New York City. It was a traffic jam. Because you can't fit all the cars that want to go to and from New York through two of the bridges and tunnels. Through two of the three things. It doesn't work. Yeah, the $1 trillion coin idea. Either way, it's all scams. It's just all scams to get money. But so what Christie did, though, is Christie literally, on the day he got into office, it was a plan from the minute it was basically his whole plan. So after that, once he got his way, that was all he ever cared about doing, was getting his hands on this money. So Christie, New York and New Jersey have, a combined like $8 billion put aside, and the federal government was matching it. So we had $16 billion ready to build a tunnel. Okay? There was as with any project, especially when it takes you 20 years to put the money together, the costs had gone up a little bit, but not nothing terrible. The costs had gone up. Christie used that as an excuse to cancel the freaking tunnel that replaces the Lincoln Tunnel. So we have this 100-year-old tunnel that's falling apart, and instead of a 10-year project where we would right now, in fact, we would now be having a new tunnel that was operational. He canceled it and took the money. And because it was set aside as funds, he was able to use it as general funds for highways, and he started handing out contracts to all of his buddies all over the state and having all these meaningless highway projects done and everything. Any excuse he could find to give away the money. And he went through the whole $3 billion. And it's it's those Sopranos kind of jobs. You ever watch Sopranos? These guys would be sitting there, they're on these projects, but there's a project, but they don't do anything. They don't just sit around talk. They don't just sit around hanging out. They're like, yeah, we get paid for this. This is how we scam money. Those jobs are actually being done in the state. I think you got the idea from the Sopranos. So anyway, so basically what's happened now is we have no money for the highway fund. I mean, we have no money to do the bridge and the tunnel. The tunnel we have is breaking down, and it's going to be a disaster. I have to move because of this, because it's going to be when the tunnel breaks, it's going to be for years a disaster to drive in this area. I love where I live, but it's going to be too terrible for words. And that's all thanks to that son of a bitch Christie. So that's what Trump is going to do to America. GNC says you're going to LTP. You know what? Frankly, I mean, I have. We took a little position on GNC, and it went very badly. So, I still think they're a good value down here, though. I do. I don't know. I don't know why nobody sees it. People are freaking out because GNC is doing a big reorganization. They're doing a relaunch. I think at the Super Bowl they have an ad, and things are going to be whatever. But people are just like, they don't believe it, and everybody sort of like lost confidence, and they want to get out of the stock. I'm like, they still make money. People still buy their stuff. Their PE is like less than 10. I think it's like 6. You know, they make $1 for every $6 for every $6 you give them for the stock, they make $1. That's really huge. That's better than Apple. They're not a pharmacy. Trump's removing regulations, so they're not going to get regulated out of existence. People aren't going to stop taking medicine. I don't care how bullshit the medicine is. The big knock on them is like, how these vitamins and supplements don't do anything. No shit. People have been sending snake oils for thousands of years. Okay, it's like you can't stop. You know, everybody knows what snake oil is, yet everybody buys it. And they're not a literal snake oil, of course, but you know. People want to believe things are going to help them and going to cure them. And frankly, some of that stuff is not a bad idea. There's certainly some things there. And I think the way he's rebranding is they are going to rebrand it to be a little more homeopathic, a little more real about what things do, and a little more nutritionally based. So I think a lot of these changes are probably worthy changes. But, you know, people are scared of it like it's going to be a startup again. So I still like him, but I'm not, until I see what happens in January, I'm certainly not willing to put more money into it. Where are we? Is there somebody synthetically collect dividends through options? Oh, of course, yeah, you buy a position, whether you buy a long call that's in the money, or whether you buy the stock, and you just sell options against the stock, sell call. We do that all the time. That's like one of the main ways we make money in the long-term portfolio. It's the only way, and by the way, in the butterfly portfolio, that's our whole strategy. It's fantastic. The butterfly portfolio kicks ass. The butterfly portfolio is by far our most conservative portfolio. And so it's up 232% in just over 3 years. So that's what, like 70% a year, 65 at least, whatever, you know. And in all 3 years, not that we've had a bad market, but you know, even in the crashes, never gave us a minute of doubt. I mean, it's been so rock steady because every position is very well hedged, and every position is, you know, they don't all work all the time. But when they work, they make so much money that it makes up for the ones that don't. And that's all we're doing basically. We're buying long positions and selling short calls and puts against our long positions. And that's all we do in this strategy. We just consistently sell premium, sell premium, sell premium, and that's our return. And I'm talking about, this is our least risky portfolio. It's just amazing how well this thing performs. And every year, you know, this is our 4th butterfly portfolio that we've run. All the butterfly portfolios, always like that. They're always the most relaxing portfolio. And literally, we do not touch this thing other than on expiration day. Each month, we then check to see what's expiring, and we buy and sell the calls and puts that we need to buy and sell, and then we don't think about it again for another month. It is the lowest touch, least volatile strategy we run, and it's so great. If I had to do one thing, boring as it is, if I had to do one thing and stick with it, I would just do this because it's the way to go. And it's exactly, but it really is, it distills the whole be the house concept that we try to teach people. It's exactly what we do try to do. Sell premium all the time. That's what that portfolio does. There's no bet, you know, there's very little betting in that portfolio. We do bet sometimes. When the market crashes, when the market crashes, we pull some of the legs out of the portfolio to turn it more bullish. Then when the market goes back, you know, when it bounces back, we then start going back to our normal routine. So every once in a while, we boost our gains by getting a bit bullish, but that's only after we find a good bottom. But also the nice thing is that we can afford it because we're so well hedged in the portfolio that even in a nasty crash, we're barely down. And so we say, we'll take a risk. What the hell? Do you like NRF? Yeah, NRF is another good one. They're a good read. Are you pretty confident selling the retail puts like B-Buy Safe, Bed Bath & Beyond? Using a 20% additional loss on Bed Bath & Beyond. I got your about puts. So, look, they make money. I like Bed Bath & Beyond. I like their store. I think they've got a good combination of stuff. You know, if I need a towel, if I need a towel, I go to Costco because I got good towels. But if I need something that's bed and bath, I'm basically going to go there. They've got lots of knickknacks. They got food now. They've got bathroom supplies. They've got all the plumbing stuff. You know, there's not too many places like that anymore. And they're you know, low end. They're not high end. So they're like, you know, it's always crowded. I go, they're always crowded, and the sales show it though. They do great numbers. And also it's not the kind of thing that, you know, it's not the kind of thing that you really buy online. Some stuff isn't good to buy online. Some stuff you want to touch or you want to see it. Like if you're buying a pillow or some linens or your sheets or your towels and you know, things like that. You know, kitchen appliances, maybe you want to, you know, it doesn't matter where you get. And frankly, they have a very small kitchen appliance section because of that. But things like that, they don't. Oh, and silverware. They have a huge silverware section. That's a good thing for them too, because it's really high margin. But again, simply, you don't buy things like that online. So they're very clever. They basically have all the things that you want to touch, and so they're the showroom basically, and that's where people want to go. So I've noticed that in the malls. There's a lot of places that have started to figure out that what you got to do is you have to feature things that you have to do things that can't be done online. And so you stick with merchandise that can't, you know, you have to stick with merchandise that people want to try on. You have to get merchandise that people want to feel or touch or try or do something with. You know, that's what you want to stick with. Those stores seem to do well in retail. So I like these guys though. You know, and again, you got to always look back. You always want to look back and say who did good in the crash, who recovered well, who handled themselves well, who didn't take a big hit. And these guys are one of them. They're a good store. You know, when people say retail's dead, that's bullshit. It's not. It's never going to be dead. I mean, to me, the malls look more crowded than ever. I mean, I think the surviving malls are doing fantastic. But again, you've got to figure out the mix that makes people happy. And the malls that are more like half food courts are doing well. So in other words, there's got to be a lot of food and a lot of hanging out. You know, there's got to be a lot of opportunity for people. Because you know, again, it goes back to it's like people aren't going to a mall to buy stuff they can buy on Amazon. They're going to a mall because there's a different experience there. And if you don't get in that experience, then there's no point in your mall. And then a lot of malls are getting killed from that stuff. The ones that are just a bunch of stores with a little food court, with an uninspiring food court, no, that doesn't work. You got to have restaurants. You got to have some really cool food. You got to have some great stands. You got to have a good mix of stores. And you know, and that's just and that's unfortunately it's not. It's the property management company is the one that has to be on top of that stuff. You know, they've got to know to make changes. But the other hard thing is that it's hard to kick your tenants out. You have to. But you know, I think fortunately for some of the smart ones, that's what happens. Some of the tenants, you know, don't go easy on your tenants if they're not doing well in business. Don't give them a hand, because a lot of these tenants are not doing well because they're never going to do well. They're out of step with the times. And you need the guys who can adapt and can bring an audience, because everyone's got to contribute and everyone's got to be interesting. It's like having a carnival and having a few lame booths. It sort of like kills the whole mood if some of your some of the booths are like turnoffs. You know, so you don't want the crowd like avoiding certain places in your thing. All right, let's see. I gotta get done with this thing. Sorry, guys. My voice is getting worse and worse. Good day. So GNC puts. Yes, did we do that already? SunPower is base saying is a negative article. You know, I like SunPower, but I wouldn't put a lot into them. But I think they're probably well priced here. And yeah, everybody thinks that everybody thinks this Trump thing is the end of solar. I like SunPower because I like the chips and I like what they're doing. So solar energy is now cheaper than petroleum. You know, your energy production cost of solar is now a better value than petroleum, and it's going to take a while for more and more people to realize that. But you know that's where economics kicks in. That's where the invisible hand of Adam Smith starts taking over, because eventually, when corporations sit down with a spreadsheet and they say, well, how do I want to power my new offices? And you can see it already in the Silicon Valley guys. But they're not doing it because they're crazy. They're doing it because they're crunching numbers. You know, Apple's building a whole giant facility that's running on solar. You know, I mean, they have to supplement it, of course, because if it's dark for a couple of days, they got a problem. And with Trump in office, it could be dark for a long time. How long does the nuclear winter last? We'll find out. You know, I think that this is a fantastic entry opportunity for these guys. And I don't think they're going bankrupt. I just think that you know, you just have to ride it out, though. So if you're willing to go long term, then I do like them. And yeah, it's easy to make a case against them, and it's easy to say they're this and that. But it's a chip business. It's a tough business, and you got to stick it out through the downturns. Yeah, Nigerian rebels, that's what you need for all these things. I mean, especially with oil prices go up. That's the other thing. It's like, why is solar not kicking off? People have forgotten the fact that, like, if oil prices go up, it's good for solar. I don't understand what's going on with that industry. It's weird. See, you know, because it's basically, you think they need support. This is the thing. We've been trained to think solar companies need government support. But that's not true anymore. They needed support. This is what's freaked out the energy industry. And this is why the oil people are taking over government, okay? Because Obama pushing the solar projects. I mean, you know how the Republicans completely attacked him with Salinger and everything? Obama putting money into solar 8 years ago has now kick-started them far enough to where they are now not competitive. They are now better than petroleum. They are more cost efficient than petroleum to use solar. They're solar energy is now the most cost-efficient form of energy to power something. Okay? But when it's available, they still have that availability issue. Once you solve the battery problem, though, that goes away too. And that will be solved. And that's why the oil companies took over America. Because this is their last chance. Because they're fighting the last leg of a battle that when they lose it, they're dead. So, of course, they're going to do anything to keep power. But you can't fight this. This is just science. It's taking over. Okay, it's like if the horse companies took over when the car was invented. You know, they took over the government. They try to keep everybody in horses. You know, you can't do it. You could try, but it's not going to last. U.S. corporate bonds yielding negative yields here. What? No, U.S. corporate bonds aren't yielding negative. Isn't the Fed's war on cash supports consumers to spend? Yeah, well, of course, they want. You don't want people to save money. And see, people don't understand this. When you have people, when your population is able to save money, okay, so when you give them enough money in work, when they can afford an apartment and they can afford to put their kids to college and they can afford their medicines and they can still save money, you know what it means? It means that every year that they work, they need the boss less and less because they're able to put money in the bank and that money starts to grow, and they're able to retire. And not, also by the way, then your workers are competing with you to buy stocks. When you make your workers rich, then your workers are also buying stocks. And if you're not careful, they can buy your company. But in general, though, if you look at it from the point of view of a guy who buys a lot of stocks, the top 1%, they don't want the bottom 99% buying stocks too. It makes them more expensive. So the last thing the top 1% wants to do is give money to the bottom 99%. The more money they have, the more competition they are for goods and services. So there's no interest at all. But more importantly, though, when you give people a living wage and people are able to save and plan for their retirement, and they're able to save and pay off their house, and let's say at age 55, they suddenly go, oh, you know what? I'm a millionaire, and I can live the rest of my life without working. Well, what happens? Now they go to their boss and say, hey, if you want me to hang around, I've got all this experience. I'm in my prime, productive years as a worker at 55 is actually a very good age for an experienced, senior man. Obviously, that's when you get promoted to be president, right, of the company. So when you've been working for a company for 20 years, they don't want you to leave if you're still healthy and able to work. But the problem is if you're already wealthy, how are they going to entice you to stay? They're going to have to pay you more money. And they know this. And that's why there's a war on Social Security. That's why they don't want to take care of your medicine. That's why they don't want you to be able to save any money. Because if they allow these things that make sense for human beings, it costs them money as a business. Because their workers are going to start saying, hey, I don't need you. I can get another job because I saved my money and my family's comfortable and I'm not worried about losing my home. That's not the kind of worker you want. You want a kind of worker who's living paycheck to paycheck. So if you threaten to fire them, they will do whatever you say right away. You want wage slaves. That's what you want. And that's how the system is set up. Maybe Trump will include that in the infrastructure bill, yeah. Buy GNC, sell it, puts and calls. 6. That's aggressive. I think that's unnecessarily aggressive, Brian. I'd go lower on the puts. They might not keep going. I like it, but I would probably go a little bit lower on the puts, like the 8s or something. How crowded is Xanadu? Xanadu's not open, but they are theoretically supposed to finish it. That would correlate to we at 2 weeks and 14 weeks from 1250 puts and calls. Yeah, I was a little more enthusiastic about it at 14. I'm getting a little worried now that they're dropping it to 11. So at this point, I would probably step back a little bit on the puts, especially when you're collecting more than 50% of what you're selling. You don't need to. And like Eric says, I like a selling stock. It is a little worrying that they're breaking down so badly. I really didn't think they'd fall that far. But, again, logically, I don't see it because GNC with a Yahoo. GNC the P is 4. Their value is now 756. This is ridiculous. The dividend, their crappy 80-cent dividend, is now 7%. Okay, here's their financials. Let's see. First of all, balance sheet. We don't have any cash. Let's see, quarterly. We should have raised some cash by now. No, okay, that's the problem. We need some cash. They've got, let's forget the balance, but, obviously they're going to need some cash. So it's true, they may dilute some things because there's going to be a cash event if they don't do something about that. So probably what people think is they're either going to have to cut dividends to raise some cash. They'll either have to cut the dividend, which of course will make the stock go lower, or they'll have to sell some stock, which will dilute the company. So that's the problem. But cash flow-wise,
They've been chewing it up here, and it's because they're paying the stupid dividends. See, this $50 million, that's their entire loss is the dividend that they're paying out. And these buybacks. Look at the size of these buybacks. 300 million, 300 million, 500 million. So so the point is cash flow coming in. 200, 300, 350. Massive cash flow. But they're putting it all out the door. They're buying back incredible amounts of stock, and they're paying off the dividends. Now, it's possible that they want to take the company private. And they might be doing all this on purpose. This happens sometimes. Sometimes the management, they want to take the company private, but they have to get rid of all the frickin' investors first. So they purposely keep coming up with bad things to keep laying out this news that just is a nonstop until they do it. In GNC, they're closing 4,000 stores. No, they're closing 4,000 stores to reset the stores. They're not. See, this is the thing. Look how this article scares the crap out of people. GNC closing 4,000 stores as they try to avert debt. No, they're changing. Goddamn, they're changing 4,000 stores because they're remodeling and redoing their strategy, and they want to do it at the beginning of the year. That was their decision. Anyway, so this, it's all psychological warfare on the investors. And I'm willing to stick it out. That's the bottom line. And by the way, okay, I don't know. Before we go back to that article, which quarter would you close if you were going to close one of your quarters? Okay, you're going to close the slowest one, the one with the least revenue, right? Which is Christmas, because people don't give vitamins for Christmas. Okay? This is not their best time of year. Spring and summer is their season when people start worrying. People make New Year's resolutions, and they start buying stuff and saying, I'm going to get healthy and blah, 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 and then by Thanksgiving, they're like, oh, the hell with it. Okay, they're not running to the vitamin shop to wrap up some glycerin for Christmas. But that doesn't stop some moron from the street. Let's see which moron it is. Ryan Sazi. So I would love to investigate him. Ryan Sazi, anyway, so they write articles like this, and it scares the crap out of investors. And it's all a scam, though. Look, the street guys, this is, Cramer's buddies. They work with, in fact, look, the street Cramer, CNBC Cramer, CNBC Cramer. That's a general article on retail. Motley Fool general article, and they're talking about stocks that can double. These Slump Today articles are stupid. They're written by computers. GNC is buying a Super Bowl ad. I want to see if every negative article is Cramer. GNC to advertise in the Super Bowl. That's not negative or positive. GNC game plan. GNC new pricing. GNC close and open. That's their own PR release, telling you that's what they're planning to do. Okay? So why on the street are they purposely, and it's not accidental, why are they purposely misrepresenting the situation? And that's the narrative that you get on CNBC too. When they talk about GNC, they talk about like doom and gloom. So that's the thing. Their goal, and I don't want to be a big conspiratorialist, but it's basically look, there's hedge funds who make a huge amount of money tanking the stock. There's other funds, there's other people who want to come in and buy the stock at rock bottom prices. How do you buy a stock for rock bottom prices? You scare everybody out of it. Cramer does this all the time. He's always putting people in at the top and chasing people out at the bottom. That's his frickin' job. He doesn't do it for CNBC. He does it for the hedge funds. Yeah, okay. Yeah, that's what I'm saying, though, Eric. When you see a buyback, that's that gargantuan. When you see negative $50 million in cash flow and a $300 million buyback, you say, I wonder if they can fix their cash flow situation. Yeah, just don't buy back so much freaking stock. That's all. It's easy to fix. Okay, so so I'm back to that. In fact, I now say I still like him at 10. I can't find anything I don't like about this stock. I'm sorry. But we'll see. We'll see. Maybe they redesigned a disaster, but that's only like guessing. It would be. I don't think they'd be doing it if they didn't think they knew what they were doing. A major change, a major rollout of a new program. I don't think they're doing it for no reason. I think they've been planning this for years. All right, guys, got to stop. Can't even talk anymore. What do you think of ANF? Oh, no, that's a disaster. No, it's been years. They just can't seem to get it together. They were trendy once, and they never figured out how to be trendy again. And they did that thing with the skinny girls or whatever. What did they do? Did they say, like, no fat chicks or something? I don't know. They did something that made the high school kids so angry. And they lost, like, to this day, my daughter, it's happened, like, a few years ago. My daughter's in high school now, and she, like, hates ANF. So, I don't know. To me, it's like, it's not a good brand. They made some horrible critical error that pissed everybody off. All right, guys. Anyway, I may as well check on the market before I give up. Boy, I really can't talk like that for 2 hours. Oh, look. Hey, finally a turn. Oh, and right where I wanted it to be, too. God damn it. I have to say I like the Russell 1360. And I know I'm like a big Russell shorter, but I like the Russell long at 1360. Because this market pops so easily. Tight stops, but this is a fun trade, so let's add a couple here. So let's do a futures trade right for our last thingy. So I'm going to buy, and I'm going to buy another one. Okay, 2. Because they're only $50 now. So see this line here? If they can't hold 1358.50, I'll just get out and I'll take a small loss. But I think now they're going to get a little bounce. We often get these bounces into the close. This is a fun one to play. Once we're over 1360, I would call that the stop. Okay, but that's all it takes. We waited patiently to see if the market would find a bottom. Everybody's turning up at the same time. That's a pretty good sign. So now that I've got my trade in, I want to check on the dollar and see if it's doing anything. The dollar's coming down nicely. See, that's another reason for it to go up. Oil's behaving itself at 54. Gasoline's still really high. Natural gas, wow, 390. The Nikkei, oh shit, that Nikkei trade is done. Look at that nice move though, right? Got a nice drop on the Nikkei. That's a done trade. The dollar, this is a good, dollar practically pulling back to where it was. And I said that this morning. I said in chat, I think this is one of those times when they're going to ram the dollar up and then ram it back down so they can goose the market. But I don't think they planned on this huge drop. I think somebody took advantage of the whole thing to get some, to sell off their positions. Ooh, silver made a nice move too. Very nice. Everyone with coffee. Coffee's dead. Like I said, though, don't look at it. I should really take off my screen. No, I'm going to take off my screen. I'll look at it again in March. All right. So Apple. Apple's not cheap enough to buy. So silver's a nice move for us, though, because we have them at 16. So 5 cents is pretty good. Anyway, all right, I'm good with that. To me, it's like we get to 1370. I don't even know the math thing. Oh yeah, now it's $100 per thing. So that's $2,000 at 1370. So that would be my hopeful goal. This is $1,000 with 2 contracts. So I'll take. No, wait, sorry. This is 60. Sorry, it's only $1,000 at 1370. So it'll be $500 if we get back to here at 1365. 1,000 at 1370. At 1365, I'd start really looking at. I might even take one off the table there, especially if it's into the overnights. But I think we should get a bounce into the close, so we'll see what happens. Anywho, all right, well, that'll be it for the day, but I'm glad we got to one futures trade, and we'll see how it goes. And Kate, of course, is having lots of fun. Again, be careful, if that turns out to be a false rumor or whatever, it'll go back down pretty fast. But I still like the trade. All right, guys, thanks everybody for coming, and next week, hopefully my voice will be all better. Have a good day.